Hello, my loves. Hello, hello. We are studying, okay? We are studying. All right. This is the book that I have to go through by the end of tomorrow, all right? I need to read everything in this book by the end of tomorrow. I can do it. I'm going to take the quizzes. I'm going to do it all, okay? It's my fault. I'm down here at the wire. I will not be rescheduling this exam. I need to get back to work. You guys know that. It's at the end. I'm sorry, you guys thought I heard something. Anyway, so what we're going to do, you guys, we are going to read. We're going to read. So if you are interested in knowing all about insurance, if you want to know the behind the scenes, if you are interested in selling insurance, this will give you a heads up on what insurance is all about. Now, state by state, they are different. I'm not saying they're different, but everybody has different rules according to their state. So this is for Ohio, but the basics is all the same. Okay, insurance was built up from a basic idea, basic thought, basic plan, and different states, they kind of just add their own twist or their own regulations and stuff like that. So, but I'm just going to go through. I am going to read each section. I am going to do an hour of reading, and then I am going to go through, do the questions, just to refresh. Whenever you're studying and you have different sections like this, that's what I suggest. I suggest you can do it a couple of different ways, okay? Especially if you have time, if you're planning ahead. So if there are questions in your study guide, I would suggest that you read the questions and try to answer them on your own first. Go through the questions, just try to answer them on your own. Give your own answer first, okay? Don't struggle with it. Don't, get upset. Don't let it cause you an anxiety or anything like that. Just try to just read the questions on your own and answer them, okay? Before reading the material. And then after you read the actual material, you go and you do the questions again. And again, you answer the questions. You can see if you're right, see if you're wrong. That's just a little extra step there. But definitely, read the material, go through the questions, and then go through the next section. What this does is it helps you to prepare for your exam and your testing. If you just read through the whole book and don't test yourself or quiz yourself, as you're going through it or after you get done with each section, it's putting a lot on you at once, okay? If you do that little review at the end and answer those questions, that makes a hell of a lot of difference, because you're kind of retaining that information at that point. Once you quiz yourself and you see that you got that right, it kind of gives you that ease to go into the next one, and and it's not so much on you at once, okay? So that's how we're going to do it. We are going to read through the sections, all right? And then we are going to, we're going to get through this book. We got 48 hours, y'all, and actually less than 48 hours. My exam is at 9 a.m. on the 23rd, and today is the 21st, okay? So let's get it. I'm going to show y'all how much of a beast I am. I'm going to show y'all, okay? All right, so we're 4 minutes in. We're going to do this for an hour at a time. Bam, 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 okay? Maybe 55 minutes because I don't want the videos to cut off. All right, so I got my coffee here. I already ate my oatmeal this morning. Y'all see I'm in my bonnet. I'm chilling. I done took my shower. I smell like good vanillas and stuff. And I put some skincare on my face, no makeup. I got to get my daughter at 1:15. I'm going to come back home. I'm going to do another at least solid hour while I'm getting dinner together. And then I got to get my son at 3 o'clock. And then I'm going to grind it out tonight, okay? So we're going to get it. We're gonna get it done, y'all, okay? All right. This first day is crucial. So the first part that we're going to start off with is general insurance, okay? So this just gives you the general basics. you know, the verbiage and all that sort of stuff, you know, you're at the basics. All right. Because how many sections are in here? There are 9. So there are nine sections. Okay. The book has total 187 pages. That ain't nothing, y'all. That ain't nothing. All right, let's go. General insurance. Before you learn about the different types of insurance policies, you need to understand some basic terminology and concepts. First, you need to know what insurance is and who or what may become insured. You also need to learn about the most common types of insurers, their classifications, and specific functions in the industry. Finally, you should understand specific terms that apply to insurance contracts, from their distinct characteristics to legal interpretations. In general, this section helps build a foundation of concepts that make it easier for you to learn the rest of the material in this course. So it is important to master these ideas before moving on to the next section. All right. Concepts. All right. Insurance. Insurance transfers the risk of loss from an individual or business entity to an insurance company, which in turn spreads the cost of unexpected losses to many individuals. If there were no insurance mechanism, the cost of a loss would have to be borne solely by the individual who suffered the loss. So, in short, insurance is like, it's just a pot. It's just like a pot of money, okay? You got this group of people, and you are all, which is your premium, you are all just paying into this pot of money. And so then when this person over here and this person over here, they have a claim, they suffer a loss, they pull out of that pot of money, you know, to cover the damage, to cover the cost of that loss. Okay? And that's basically what it is. Otherwise, if there wasn't insurance, what? If you don't have insurance, then whatever loss you incur, it's on you. You are the sole person responsible for the financial responsibility in whatever the loss is. All right. Number 2, insurance transactions. The term insurance transaction includes any of the following: by mail or any other means: solicitation, negotiations, sale, effectuation of a contract of insurance, or advertising. I can't read y'all, I'm sorry. Or advising an individual concerning coverage or claims. So those are the different types of insurance transactions. Risk management key terms. Risk. Risk is the uncertainty or chance of a loss occurring. The two types of risk are pure and speculative, only one of which is insurable. Pure risk refers to situations that can only result in a loss or no change. There is no opportunity for financial gain. Pure risk is the only type of risk that insurance companies are willing to accept. Speculative risk involves the opportunity for either loss or gain. An example of a speculative risk is gambling. These types of risks are not insurable. If you could, one up them, or they can one up you, they're not going to insure it. Exposure. Exposure is a unit of measurement used to determine rates charged for insurance coverage. A large number of units having the same or similar exposure to loss are referred to as homogeneous. I done already read this section, y'all, so I know how to say this word. Homologous are referred to as homologous. The basis of insurance is sharing risk between a large homologous group with similar exposure to loss. Hazard. Hazards are conditions or situations that increase the probability of an insured loss occurring. Hazards are classified as physical hazards, moral hazards, morale hazards. Conditions such as lifestyle and existing health or activities such as scuba diving are hazards and may increase the chance of a loss occurring. Physical hazards are individual characteristics that increase the chances of the cause of loss. Physical hazards exist because of a physical condition, past medical history, or a condition at birth, such as blindness. Moral hazards are tendencies towards increased risk. Moral hazards involve evaluating the character and reputation of the proposed insured. Moral hazards refer to those applicants who may lie on an application for insurance or in the past have submitted fraudulent claims against an insurer. Moral hazards are similar to moral hazards, except that they arise from a state of mind that causes indifference to loss, such as carelessness. Actions taken without forethought may cause physical injuries. Peril. Perils are the causes of loss insured against in an insurance policy. Life insurance insures against the financial loss caused by the premature death of the insured. Health insurance insures against the medical expenses and/or loss of income by the insured sickness or accidental injury. Property insurance insures against the loss of a physical property or the loss of its income-producing abilities. Casualty insurance insures against the loss and/or damage of property and resulting liabilities. Loss. Loss is defined as the reduction, decrease, or disappearance of value of the person or property insured in a policy caused by a named peril. Insurance provides a means to transfer. So again, insurance transfers the responsibility of the loss to the company instead of the insured themselves having to take on that responsibility all on their own. So then you have your keywords here. Hazards. Just you want to review those. Hazards, conditions and actions that increase risk or probability of loss. Perils are causes of loss. Loss, reduction of value, basis for a claim. Insurance, transfer of loss, protection. Number 4, methods of handling risk. Number 1 is avoidance. One of the methods of dealing with risk is avoidance, which means eliminating exposure to a loss. For example, if a person wanted to avoid the risk of being killed in an airplane crash, he or she might choose never to fly in an airplane. Risk avoidance is effective but seldom practical. Retention. Risk retention is the planned assumption of risk by an insured through the use of deductibles, co-payments, or self-insurance. It is also known as self-insurance when the insured accepts the responsibility for the loss before the insurance company pays. The purpose of retention is, number 1, to reduce expenses and improve cash flow. Number 2, to increase control of claim reserving and claim settlements. And number 3, to fund for losses that cannot be insured. Sharing. Sharing is a method of dealing with risk for a group of individual persons or businesses with the same or similar exposure to loss to share the losses that occur within that group. A reciprocal insurance exchange is a formal risk-sharing program. A formal risk-sharing arrangement. Reduction. Since we usually cannot avoid risk entirely, we often attempt to lessen the possibility or severity of a loss. Reduction would include actions such as installing smoke detectors in our homes, having an annual physical to detect health problems early, or perhaps making a change in our lifestyles. Transfer. The most effective way to handle risk is to transfer it so that the loss is borne by another party. Insurance is the most common method of transferring risk from an individual or group to an insurance company. Though the purchasing of insurance will not eliminate the risk or death or illness, it relieves the insured of the financial losses these risks bring. There are several ways to transfer risk, such as hold harmless agreements and other contractual agreements, but the safest and most common method is to purchase insurance coverage. Number 5, elements of insurable risk. Not all risks are insurable. As noted earlier, insurers will insure only pure risk, or those that involve only the chance of loss with no chance of gain. Furthermore, even pure risk must have certain characteristics in order to be insurable. Insurable risk involve the following characteristics. Due to chance, a loss that is outside of the insured's control. Definite and measurable, a loss that is specific as to the cause, time, place, and amount. An insurer must be able to determine how much the benefit will be and when it becomes payable. Statistically predictable. Insurers must be able to estimate the average frequency and severity of future losses and set appropriate premium rates. In life and health insurance, the use of mortality tables and morbidity tables allows the insurer to project losses based on statistics. Not catastrophic. Insurers need to be reasonably certain their losses will not exceed specific limits. That is why insurance policies usually include coverage for loss usually exclude coverage for loss caused by war or nuclear events. There is no statistical data that allows for the development rate of rates that would be necessary to cover losses from events of this nature. Randomly selected and large loss exposure. There must be a sufficiently large pool of the insured that represents a random selection of risk in terms of age, gender, occupation, health, and economic status, and geographic location. Adverse selection. Number 6. Insurance companies strive to protect themselves from adverse selection. The insuring of risks that are more prone to losses than the average risk. Poorer risks tend to seek insurance or file claims to a greater extent than better risk. To protect themselves from adverse selection, insurance companies have an option to refuse or restrict coverage for bad risk, or charge them a higher rate for insurance coverage. And don't we all know, if you got a bad driving record, your insurance is going to be a lot higher than a person who ain't never had a ticket. Number 7, Law of large numbers. The basis of insurance is sharing risk among a large pool of people with a similar exposure to loss. A homologous group. The large... I don't know what the hell. What's going on? The law of large numbers states that the larger the number of people with a similar exposure to loss, the more predictable actual losses will be. This law forms the basis for a statistical prediction of loss upon which insurance rates are calculated. Example: when an insurance company issues a policy on a 35-year-old male, the company really has no way of knowing or accurately predicting when he will die. However, the law of large numbers looks at a large group of similar risks, 35-year-old males of similar lifestyles and health conditions, and makes some conclusions based on statistics of past losses. This allows the insurance company to have a general idea about the predicted time of death for this type of insured and to set the premiums accordingly. Y'all see how they be predicting when we gonna die? How they calculate our life insurance? Just so now you know how they calculate your premium. Reinsurance. Reinsurance is a contract under which one insurance company, the reinsurer, indemnifies another insurance company for part or all of its liabilities. The purpose of reinsurance is to protect insurers against catastrophic losses. The originating company that procures insurance on itself from another insurer is called the ceding insurer because it cedes or gives the risk to the reinsurer. The other insurer is called the assuming insurer or reinsurer. When reinsurance is purchased on a specific policy, it is classified as a facultative reinsurance. When an insurer has an automatic reinsurance agreement between itself and the reinsurer, in which the reinsurer is bound to accept all risk ceded to it, it is classified as a reinsurance treaty. Treaties are usually negotiated for a period of a year or longer because even though the insurance company is who they are, they still need to be protected as well. B. Insurers. An insurer is any person or company engaged as the principal party in the business of entering into insurance contracts. There are several classifications of insurers depending on the type of ownership, location of incorporation, and other characteristics. 1. Types of insurers. Insurance is Insurance is available from both private companies and the government. The major difference between government and private insurance is that the government programs are funded with taxes and serve national and state social purposes, while private policies are funded by premiums. Private insurance companies can be classified in a variety of ways: ownership, authority to transact business, location, marketing and distribution systems, or rating, their financial strength. Now, like they said, you can have the private insurance companies, which is funded by your premium. So they calculate a premium for the policy that you are purchasing, and all of these different premiums is what funds your insurance. That's what pays for your claim if you were to suffer a loss. And then insurance that is provided by the government, like they said, is funded by taxes that they charge citizens. So that would be, when you go into like Medicare, Medicaid, and stuff like that, health insurance that is funded by the taxpayers versus, that person on Medicaid paying the government a premium. As you read about different classifications of insurers, keep in mind that these categories are not mutually exclusive, and the same company can be described based on where it is located and allowed to transact business, the business of insurance, who owns it, and what type of agents it appoints. Stock companies. Stock companies are owned by the stockholders, who provide the capital necessary to establish and operate the insurance company, and who share in any profits or losses. Officers are elected by the stockholders and manage stock insurance companies. Traditionally, stock companies issue non-participating policies in which policy owners do not share in profits or losses. A non-participating stock policy does not pay dividends to policy owners. However, taxable dividends are paid to stockholders. Mutual companies. Mutual companies are owned by the policy owners and issue participating policies. With participating policies, policy owners are entitled to dividends, which in the case of mutual companies are a return of excess premiums and are therefore non-taxable. Dividends are generated when the premiums and earnings combined exceed the actual cost of providing coverage, creating a surplus. Dividends are not guaranteed. So, if you have sometimes, I know at the company where my auto insurance is. If, there's every so often where the company, they collected more premium than was needed to, for the coverage that was provided the prior year. So they will either issue policy owners, they will either issue them a lower premium when they for the next policy period, or they will issue them some type of discount usually. And then you have some companies that will send you like an actual check, but like my insurance company, they would just like give you a lower premium that next year. Fraternal benefit societies. A fraternal benefit society is an organization formed to provide insurance benefits for members of an affiliated lodge, religious organization, or fraternal organization with a representative form of government. Fraternals sell only to their members and are considered charitable institutions and not insurers. They are not subject to all of the regulations that apply to the insurers that offer coverage to the public at large. Reciprocals. A reciprocal is insurance resulting from an interchange of reciprocal agreements of indemnity among persons known as subscribers, collectively known as reciprocal insurance company or exchange. The company is put into effect and administered through an attorney-in-fact common to all persons. Subscribers agree to become liable for their share of losses and expenses incurred among all subscribers, and they authorize the attorney-in-fact to manage and operate the exchange. Risk retention groups. A risk retention group is a liability insurance company owned by its members. The members are exposed to similar liability risk by virtue of being in the same business or industry. The purpose of a risk retention group is to assume and spread all or part of the liability of its group members. A risk retention group may reinsure another risk retention group's liability as long as the members of the second group are engaged in the same or similar business or industry. Lloyd's associations. Lloyd's is not an insurance company. Lloyd's provides support facilities for underwriters or groups of individuals that accept insurance risk. Lloyd's associations are a group of individuals who operate an insurance mechanism using the same principles of individual liability of insurers that Lloyd's of London uses, in that each individual underwriter assumes a part of each risk. Each individual promises to pay a specified amount in the event that the contingency, Lord, this probably wasn't a good idea. I can't read, y'all. Event that the contingency insured against occurs. Members are liable only for their portion of the risk and are not bound to assume any portion of a defaulting member. While Lloyd's formed in this country operate in essentially the same manner as Lloyd's of London, they are not subject to the strict regulation which Lloyd's of London imposes upon its members. Most states have laws which prohibit the organization or licensing of American Lloyd's. Those Lloyd's which do exist operate almost exclusively in the property insurance field. So they're like strictly in home insurance. Surplus lines. Surplus lines is insurance for which there is no readily available admitted market. Such coverages are marketed through non-admitted insurers who specialize in offering insurance to the high-risk market on an unregulated basis under each state's surplus lines laws. While surplus lines insurers are not admitted, most states require that they be on that state's approved list. Well, if they're not admitted. Number 2, authorized or admitted versus unauthorized or non-admitted insurers. Before insurers may transact business in a specific state, they must apply for and be granted a license or certificate of authority from the State Department of Insurance and meet any financial, capital, and surplus requirements set by the state. Insurers who meet the state's financial requirements and are approved to transact business in the state are considered authorized or admitted into the state as a legal insurer. Those insurers who have not been approved to do business in the state are considered unauthorized or non admitted. Most states have laws that prohibit unauthorized insurers to conduct business in the state except through licensed excess and surplus lines brokers. So to even become an insurance company, you have to apply through the state of insurance and be approved to sell the insurance. Number 3, domestic, foreign, and alien insurers. Insurance companies are classified according to the location of incorporation. Regardless of where an insurance company is incorporated, it must obtain a certificate of authority before transacting insurance within the state. A domestic insurer is an insurance company that is incorporated in this state. In most cases, the company's home office is in the state in which it was formed, the company's domicile. For instance, a company chartered in Pennsylvania would be considered a Pennsylvania domestic company. A foreign insurer is an insurance company that is incorporated in another state or territorial possession, such as Puerto Rico, Guam, or American Samoa. For example, a company chartered in California would be a foreign company within the state of New York. An alien insurer is an insurance company that is incorporated outside of the United States. Number 4, financial solvency status, independent rating services. The financial strength and stability of an insurance company are two vitally important factors to potential insurers. The financial strength of an insurance company is based on prior claims, experience, investment earnings, level of reserves, and that's the amount of money kept in a separate account to cover debts to policyholders, and management, to name a few. Guides to insurance companies' financial integrity are published regularly by the following various independent rating services: AM Best, Fitch, Standard & Poor's, Moody's, and Weiss. So this is huge, especially for life insurance, you guys. Before you decide who to purchase life insurance from, you should always look up the financial stability of the company that you are purchasing that policy from. Because you don't want, you're going to be gone anyway, but it would be a shame for you to pay a premium to a company over years and years, and then upon your death, and you don't have any money. They're not able to pay, or they're not stable, and you're paying them a premium, and then they end up going out of business or something like that. You need to check their financial stability and keep up on it as well. Don't just check it before you buy the policy, but check it. It may be, you may have had your policy for 5 years. Check them and see how they're doing, because you're paying your money into this place, and no, you won't be able to help if the company does go down, but you can damn sure help if you continue to pay your money into a company that isn't going to be able to, to pay up when it's needed. Number 5, marketing, distribution systems. Insurance companies market their products in different ways through agent or direct solicitation to the customers. Type of marketing arrangements. Independent agency system, American agency system. Those characteristics are: one independent agent represents several companies, non-exclusive, commissions on personal sales, business renewal with any company. Next, exclusive agency system, captive agents. One agent represents one company, exclusive, commissions on personal sales, renewals can only be placed with the appointing insurer. Next, general agency system. General agent entrepreneur represents one company, exclusive, compensation and commissions, appoints sub-agents. Next, managerial system. Branch manager supervises agents, salary. Agents can be insurers, employees, or independent contractors. Last, direct response marketing system. No agents. Company advertises directly to consumers through mail, internet, television, other mass marketing. Consumers apply directly to the company. Yeah, so that last one, they don't have agents. You know how you have your agent office. You got, you might got your Progressive agent office. You might got your State Farm agent office. And so that's what that means. Basically how the different companies advertise their product. All right. All right, so C. Agents and general rules of agency. Number 1, agent and insurer relationship. An agent slash producer is an individual licensed to sell, solicit, or negotiate insurance contracts on behalf of the principal insurer. The law of agency defines the relationship between the principal and the agent slash producer. The acts of the agent within the scope of authority are deemed to be the acts of the insurer. In this relationship, it is a given that an agent represents the insurer, not the insured. Any knowledge of the agent is presumed to be knowledge of the insurer. If the agent is working within the conditions of his or her contract, the insurer is fully responsible. When the insured submits payment to the agent, it is the same as submitting a payment to the insurer. The agent is responsible for accurately completing applications for insurance, submitting the application to the insurer for underwriting, and delivering the policy to the policy owner. Number 2, authority and power of agents. The agency contract details the authority of an agent has within his or her company. Contractually, only those actions for which the agent is authorized can bind the principal, the insurer. In reality, an agent's authority is much broader. There are 3 types of agent authority: express, implied, and apparent. Express authority is the authority a principal intends to grant to an agent by means of agent's contract. It is the authority that is written in the contract. It is expressed. Implied authority is authority that is not expressed or written into the contract, but which the agent is assumed to have in order to transact the business of insurance for the principal. Implied authority is incidental to and derives from express authority, since not every single detail of an agent's authority can be spelled out in the written contract. Example: if the agency contract does not specifically authorize the agent to collect premiums and remit them to the insurer, but the agent routinely does so in the process of solicitation and delivery of policies, the agent has the implied authority to collect and remit premiums. Okay? So it's not written that he's able to take the payment or she is able to take the payment and deliver the policy, but if they have to deliver the policy, they have to collect the payment for it, right? All right. An apparent authority, also known as perceived authority, is the appearance of the assumption of authority based on the actions, words, or deeds of the principal, or because of the circumstances the principal created. For example, if an agent uses the If an agent uses insurer stationery when soliciting coverage, an applicant may believe that the agent is authorized to transact insurance on behalf of the insurer. So you're an agent for a specific company, and when you are communicating with them on their letterhead, it is assumed that this person, you represent this company that you are communicating for. Number 3, responsibilities to the applicant or insured. Although the agents act for the insurer, they are legally obligated to treat applicants and insureds in an ethical manner. Because an agent handles the funds of the insured and the insurer, he or she has fiduciary responsibility. A fiduciary is someone in a position of trust. More specifically, it is illegal for insurance producers to commingle premiums collected from the applicants with their own personal funds. Market conduct describes the way companies and producers should conduct their business. It is a code of ethics for producers. Producers must adhere to certain established procedures, and failure to comply will result in penalties. Some of the market conducted regulations include, but are not limited to, the following: conflict of interest, a request or a gift or loan as a condition to complete business, supplying confidential information. Producers are required to perform in a professional manner at all times. Professionalism means that a person is engaged in an occupation requiring an advanced level of training, knowledge, or skill. Being professional means placing the public's interest above one's own in all situations. Any deviation could result in a penalty. Absolutely. D, contracts. An agent is an individual licensed to sell, solicit, or negotiate insurance contracts on behalf of the principal, which is the insurer. The law of agency defines the relationship between the principal and the agent. The acts of the agent within the scope of authority are deemed to be the acts of the insurer. In this relationship, it is a given that an agent represents the insurer, not the insured. Any knowledge of the agent is presumed to be knowledge of the insurer. If the agent is working within the conditions of his or her contract, the insurer is fully responsible. And when the insured submits payment to the agent, it is the same as submitting a payment to the insurer. The agent is responsible for accurately completing applications for insurance, submitting the application to the insurer for underwriting, and delivering the policy to the policy owner. Elements of a legal contract. In order for insurance contracts to be legally binding, they must have 4 essential elements: agreement, offer and acceptance, consideration, competent parties, and legal purpose. Offer and acceptance. There must be a definite offer by one party, and the other party must accept this offer in its exact terms. In insurance, the applicant usually makes the offer when submitting the application. Acceptance takes place when insurer's underwriter approves the application and issues a policy. Consideration. The binding force in any contract is the consideration. Consideration is something of value that each party gives to the other. The consideration on the part of the insured is the payment of the premium and the representations made in the application. The consideration on the part of the insurer is the promise to pay in the event of a loss. Competent parties. The parties to a contract must be capable of entering into a contract in the eyes of the law. Generally, this requires that both parties be of legal age, mentally competent to understand the contract, and not under any influence of drugs or alcohol. Legal purpose. The purpose of the contract must be legal and not against the public policy. Number 2, district characteristics of an insurance contract. In addition to required elements, insurance contracts have unique characteristics that distinguish them from the other types of legal contracts. It is important to understand these features and how they affect parties to an insurance contract. Contract of adhesion. A contract of adhesion is prepared by one of the parties and accepted or rejected by the other party. Insurance policies are not drawn up through negotiations, or an insured has little to say about its provisions. In other words, insurance contracts are offered on a take it or leave it basis by an insurer. And that's it. It is as it's written. Aleatory contract. Insurance contracts are aleatory, which means there is an exchange of unequal amounts or values. The premium paid by the insured is small in relation to the amount that will be paid by the insurer in the event of a loss. Example: John purchases a homeowner's policy for $100,000. His monthly premium is $100. If John only had the policy for 2 months, which means he only paid $200 in premiums, and the home was unexpectedly destroyed by a covered peril, John will receive $100,000. A $200 contribution on the part of the insured in exchange for $100,000 benefit from the insurer illustrates an aleatory contract. Personal contract. In general, an insurance contract is a personal contract because it is between the insurance company and an individual. Because the company has a right to decide with whom it will and will not do business, the insured cannot be changed to someone else without the written consent of the insurer, nor can the owner transfer the contract to another person without the insurer's approval. Life insurance is an exception to this rule. A policy owner can transfer or assign ownership to another person. However, the insurer must still be notified in writing. So, you can always change your beneficiary on your life insurance. Don't think that when you first get a life insurance policy that you can, that's it. It's written in stone. Because a lot of times when you get life insurance, and it's like, who are you going to list as your beneficiary? And you're stuck. Just know to list somebody, because if you don't list somebody, the money is going to go to the state, taxes, probate, all of that stuff. It's going to be a big old mess. So always list it to somebody, but you can always change that as well. So don't think that it's set in stone once you do it. All right, unilateral contract. In a unilateral contract, only one of the parties to the contract is legally bound to do anything. The insured makes no legally binding promises. However, an insurer is legally bound to pay losses covered by a policy in force. Conditional contract. As the name implies, a conditional contract requires that certain conditions must be met by the policy owner and the company in order for the contract to be executed. And before each party fulfills its obligations, for example, the insured must pay the premium and provide a proof of loss in order for the insured to cover a claim. Number 3, legal interpretations affecting contracts. Ambiguities in a contract of adhesion. Because only the insurance company has the right to draw up a contract, and the insured has to adhere to the contract as issued, the courts have held that any ambiguity in the contract should be interpreted as in favor of the insured. Reasonable expectations. It is not always practical or necessary to state every direct and indirect provision of coverage offered by an insurance policy. If an agent implies through advertising, sales literature, or statements that these provisions exist, an insured could reasonably expect coverage. So, there's just certain things in some policies that are just not stated right there in the contract. but they exist. They're just unwritten. Like at my insurance company, you are allowed to let a person drive your car and your car would still be covered in the case of an accident. So even though their name isn't on the policy, they're not in your household, it could just be a friend of yours, as long as I gave them permission to drive my vehicle, that it's covered just as if it were me driving, but it's not written anywhere. You know what I'm saying? The same as if your name is on your policy, but you have other people in your household. As long as they're licensed, they're in your house, even if they're not licensed with my insurance company. But say you have somebody in your household, every person in your household isn't going to be written on that ID card, but they are allowed to drive the vehicle because they're a part of the household. All right. So next one, indemnity. Indemnity, sometimes referred to as reimbursement, is a provision in an insurance policy that states that in the event of a loss, an insured or a beneficiary is permitted to collect only to the extent of the financial loss and is not allowed to gain financially because of the existence of an insurance contract. The purpose of insurance is to restore, but not to let an insured or beneficiary profit from the loss. Example, Brenda has a home insurance policy for $200,000. After her home was destroyed, her expense to rebuild the home added up to $150,000. The insurance policy will reimburse Brenda only for $150,000, the amount of the loss, and not for $200,000, the total amount of insurance. So you see how that works? Now you see in a previous example, they said, he only had his policy for 2 months before his house burned down and he got the whole $100,000, right? Okay. So you do have a choice. Now, every company is different, so don't quote me. You always got to check with and see what is in your policy. But in Ohio and with certain companies, the company I'm insured with, if my house burnt down and I chose not to rebuild, then boom, they're just going to cash me out the stated amount of my policy. Okay. Now, if I choose to rebuild, depending on the cost to rebuild, depending on what the contractors charge, I could be insured for up to $200,000, and that's up to $200,000. Now, if it goes over that, it's on me. Okay. But if it's under that, I'm not going to get that difference. I'm not going to get that $50,000 difference. Because it's only insurance is to put you back in the same situation you were in before the loss happened, is what insurance is all about. Okay. It's not to make you better. It's to keep you the same. Okay. Utmost good faith. The principle of utmost good faith implies that there will be no fraud, misrepresentation, or concealment between the parties. As it pertains to insurance policies, both the insurer and insured must be able to rely on the other for relevant information. The insured is expected to provide accurate information on the application for insurance, and the insurer must clearly and truthfully describe policy features and benefits and must not conceal or mislead the insured. Representations and misrepresentations. Representations are statements believed to be true to the best of one's knowledge, but they are not guaranteed to be true. For insurance purposes, representations are the answers the insured gives to the questions on the insurance application. Untrue statements on the application are considered misrepresentations and could void the contract. A material misrepresentation is a statement that, if discovered, would alter the underwriting decision of the insurance company. Furthermore, if material misrepresentations are intentional, they are considered fraud. Warranties. A warranty is an absolutely true statement upon which the validity of the insurance policy depends. breach of warranties can be considered grounds for voiding the policy or a return of premium. Because of such a strict definition, statements made by applicants for life and health insurance policies, for example, are usually not considered warranties, except in cases of fraud. Concealment. Concealment is the legal term for the intentional withholding of information of a material fact that is crucial in the making of a decision. In insurance, concealment is withholding of the information by the applicant that will result in an imprecise underwriting decision. Concealment may void a policy. Fraud. Fraud is the intentional misrepresentation or intentional concealment of material fact used to induce another party to make or refrain from making a contract or to deceive or cheat a party. Fraud is grounds for voiding an insurance contract. I'm sorry, I'm stuttering. Waiver and estoppel. Waiver is the voluntary act of relinquishing a legal right, claim, or privilege. Estoppel is a legal process that can be used to prevent a party to a contract from reasserting a right or privilege after that right or privilege has been waived. Estoppel is a legal consequence of a waiver. Flashback. Test your retention of new concepts you learned. Flashback to the beginning of the chapter to review the snapshots before moving forward. Okay, so we are all done with the first one. So we got questions in the front. So we're going to go through the questions and see if I can answer them. The first one is, what is insurance? What is insurance? Insurance is transferring the risk of loss. Okay, so insurance is transferring the risk of loss from me to the insurance company. What is included under the term insurance transaction? Oh, what is included under the term insurance transaction? I don't know. Solicitation, negotiations, sale, advising an individual concerning coverage or claims. So what is included under the term of insurance transaction? So in an insurance transaction, you can solicit, you will negotiate, you will sell the contract, you can advise them. You can advise them regarding the coverage, you can advise them about claims. Okay, so I didn't know that one. What is risk? Risk is the loss. Risk is the oh my God, you guys. I don't remember none of this. So risk, like if you got the answers in front of you, you know, but risk is that there may be a loss. There's a probability that there will be a loss. Okay. What is apparel? Apparel is a loss. All right, so that's it. Oh, what is the difference between domestic, foreign, and alien insurance companies? So domestic is domestic insurance company is the state that you started your insurance company in. The state that you started your insurance company in is the same state that you're operating out of. Foreign is I start my insurance company. It's based in Ohio, but I am operating in Georgia. And alien insurance companies is insurance companies out of the country. They're not even in the same country. And that's it. That's it. Oh, What is the difference between an authorized admitted and unauthorized non-admitted insurer? So an authorized or admitted insurer is one who has a certificate of authority that was approved to them by the Department of Insurance, and an unauthorized or non-admitted insured is not. They are not approved to sell insurance in the state by the state of insurance or by the Department of Insurance. And that's it. So I'm first two, y'all. I was struggling. I had to cheat on that one. But I didn't skip through and go through. Okay, so all right, so you guys, so we're at an hour and we finished our first one and we went through our first questions. So that's it. We are out of here. We got our first hour done. We are on to the next. See y'all in a minute.